All right, so we're going to look at the depletion of natural resources. Natural resources, the examples of that would be timber, ores, minerals, oil, natural resources from the earth. And as we harvest these, we mine them, we sell them, a portion of the cost of acquiring them should be expense, similar to depreciation for fixed assets. And we call this process for natural resources depletion. So to calculate depletion, first we have to calculate the depletion rate. So the depletion rate is the cost of the resource over the estimated total units we think we're going to get from the resource. And then we take that depletion rate, multiply it by the quantity extracted, and we come up with our depletion. So let's look at an example. So we paid $400,000 for the mining rights to a deposit, and we think we're going to get 1 million tons of ore from it. So our depletion rate comes out to 40 cents a ton. We take the $400,000 cost divided by the million tons we think we're going to get from it, and we get 40 cents a ton. So let's just say we mined 90,000 tons from this deposit. Our depletion expense comes out to $36,000. 40 cents a ton times 90,000 tons gets us to $36,000. Then to record this on our books, we create an account called accumulated depletion, which is a negative asset account similar to accumulated depreciation. We recognize depletion expense on our income statement, and we know expenses reduce retained earnings. Intangible assets. So long-lived, they're not used in the normal operations of a business, not held for sale. So this would be your patents, your copyrights, your trademarks, and an item called goodwill. They don't exist physically, they're intangible. You can't see them. You can't see a patent, you can't see a copyright. They're not physical, they're intangible. The accounting is similar to fixed assets, similar to straight line depreciation. And the cost for intangible assets is called amortization. So we depreciate fixed assets, we deplete natural resources, and we amortize intangible assets. So looking at the types of intangible assets, the big one is goodwill. Goodwill is if you say you buy a company for $100 million, and their balance sheet shows that the company is worth $60 million. The $40 million excess is goodwill. So you're paying for the name, the customers. That's what you're paying for. That's called goodwill, what you pay for a company above and beyond what the balance sheet says it's worth. And then so on. The next one, trademarks, copyrights. So that'd be Coca-Cola, the trademark brand name Coca-Cola. That's a very valuable intangible asset. Patents. Pharmaceutical companies, patents are huge. So amortization, conceptually what we're trying to do is match the cost of an intangible asset with the revenue over its useful life. So it's similar to straight line depreciation. So our cost of amortization is our cost minus our estimated residual value over the estimated useful life. Looks a lot like straight line depreciation. So let's take a look at an example. So we acquire a patent for $100,000. The remaining legal life of the patent is 14 years, but we feel its useful life is only 5 more years. Well, we're going to use our useful life of 5 years. So we do $100,000 divided by 5 years. So our amortization every year is going to be $20,000. When recording amortization, we don't have an accumulated amortization account. When recording amortization, we reduce the asset. So we're going to reduce the asset patent by $20,000. And then on our income statement, we're going to have amortization expense for $20,000. And we know expenses reduce retained earnings. Goodwill is created from favorable business factors. It's determined by a transaction. So that company we pay $100 million for, the balance sheet says it's worth $80 million. We have $20 million of goodwill. You never amortize goodwill. Goodwill is tested for impairment, but it's not amortized. And it's frequently reported because typically when you buy another company, you're going to have goodwill. So here's some common intangible assets. So patents and copyrights, we amortize them. Trademarks and goodwill, we test for impairment. And on our reporting, we record depreciation and amortization separately on our income statement. So you'll see a line that says depreciation expense, a line for amortization expense. And then in our footnotes, we typically show how we calculated those numbers. On our balance sheet, we show different classes of fixed assets. Machinery and equipment, land, patents, copyrights. They're reported separately. And then the accumulated depreciation is also reported. So here's an example of a balance sheet. So here's our asset section. We have property, plant, and equipment, land, buildings, equipment, and then we have mineral deposits, which are natural resources. And then further down, we have intangible assets, our patents and goodwill. So we have our property, plant, and equipment and mineral deposits go under property, plant, and equipment, the $1,629,000, and then underneath we have our intangible assets for $125,000.